Let's talk markets right now as we kick off a new trading month and get ready for the jobs report later this week. Ed Yardeni is the president of Yardeni Research. And Ed, good morning to you.
Morning.
Let's talk a little bit about what we see post-earnings season. I think you point out that 98% of the S&P 500 have reported. Right. That leaves only 10 companies left. Pretty good time to take assessment of what happened and what we should expect for the rest of this year.
Well, all in all, I'd say that the results were better than expected. Coming into the earnings season, the analysts were looking at something like a 1% to 2% increase in earnings, S&P 500 earnings on a year-over-year basis, and it came in more like 6% to 7%. There's still a few more companies to report, but clearly a much better result. And we definitely are seeing that in analysts' estimates of earnings for this year, next year, and in the following year. They've been raising their numbers. So all in all, this certainly justifies the bull market.
Yeah, you've got year-end targets, 5,400 for the S&P 500 by the end of this year, right. 6,000 by the end of next year, and I think it's 6,500 by the end of 2026. That is part of your roaring 20s analysis. We're not talking 1920s, we're talking the 2020s this time. So you still see a long way to go with this bull market.
I do. I think it's actually fairly early on. Some people are talking about it being mid-cycle, a bull market, or getting near the end of the story. But I don't think that's the case. I think we're going to continue to see surprisingly strong productivity. We're not seeing that, obviously, in the first quarter numbers. But last year we had very strong productivity, and I think that's going to continue into this year and beyond. So, yes, I think there are similarities between the 2020s and the 1920s, and that's technology-led productivity that increased standards of living, which I think we're seeing now.
And that profit margins, as a result, are going to continue to climb too?
Correct. For many years, prior to the maybe past 10 years, everybody thought that the profit margin was just a very cyclical variable that just went sideways. But the trend's actually been to the upside. And we're thinking that we could be seeing something like a 13 to 14% profit margin for the S&P 500 in the next couple of years.
I mean, that's pretty amazing for the short and maybe even the medium term. But we know how the 1920s ended. You see a similar sort of crash coming, and if so, what would cause it?
No, I mean, at this point, it's hard to see that far ahead. But if we use that analogy, the problem that we had in the 1920s, well, the reason it ended so badly is because Congress and the president at that time, Hoover, signed the Smoot-Hawley tariff in June of 1930. If you look at a chart of the Dow Jones Industrials Average, you'll see that, the Great Crash started in October of 1929, but then in early 1930, we actually reversed that and regained about half of what we lost. So it was no big deal until the June 3rd, 1930 passage of Smoot-Hawley, and that caused the Great Crash. And I think it was a big contributor to the Depression. Other factors were important too, but that one was a big one.
Well, then it's a good thing nobody is talking about tariffs these days.
Well, you're absolutely right. That's the risk, of course, is the risks are largely geopolitical in nature, in addition to the wars between Russia and Ukraine and the Middle East. We're certainly seeing the potential for a trade war. And so that is something to be aware of. Look, my base case is that it will be the 2020s, but I'm not going to tell you that it couldn't slip into something more like a 1930s environment, as we saw at the beginning because of because of tariffs.